What's up, everybody? It's Jonathan. Today, we're going to talk about scalping gamma. I'm going to walk you through an example in KEM, K-E-M. Now, in my opinion, learning how to scalp gamma, learning how to manage your position is probably the most important thing for any trader learning how to trade stock options. It's an absolute necessity. So let me walk you through an example of a trade that we shared June 11th. Today, July 2nd. So June 11th, we shared an idea in KEM, K-E-M. Here's the date. The trade that was shared was buying one July 24 strike call, 60 cents. Let's use the example of a one lot. It's $60. You can never lose more than 60 bucks. We're also buying one July 21st strike put, 50 cents, risk $50. You can never lose more. So if you do both sides of the trade, if you do a one lot, it's $110. If you do a 10 lot, it's $1,100. But let's use the example of a one lot. I highlighted the area of the trade, but I also made a line on the 24 strike. Now I probably could do the same thing on the 21 strike, but the stock never traded down there, so don't worry about it, okay? Buying one July 21 strike put allows you to be short at 21 if the market's under 21. The market's not under 21, so it doesn't matter. They're worthless. We have the option to be short. We're going to choose not to be short because the price of the stock right now is $25.67. So let's just worry about the 24 strike call. And I'm going to show you how professional traders would manage this trade. Again, we have $110 of risk right now when we put the position on. So here we go. Right away there's volatility, but it's not really helping us very much because it's not moving away from our strike. But all of a sudden we start to rally. So now the 24 strikes are in the money. Now again, the 21 strikes, ignore them. We're nowhere close. The 24 strikes are in the money, fine. They're doing well. What I suggest, what I teach, 25. We're up $1, or we have $1 of intrinsic value in those 24 strikes. So what I'm always going to suggest that people do, sell 30 shares of stock. Sell 30 shares of the underlying stock of KEM. If you sell them for $25 at the price of $25, your position, you're still long one. You never touched your options. Now you're short 30 shares of the underlying stock. The reason we do this is because being long one of the 24 strike calls, it's the same thing as being long 100 shares of KEM once we're in the money. So if I sell 30 right here, we're long one call, short 30 shares of stock. Okay, let's just trade whole numbers for this example. So now we just hold. We're not doing anything. It looks like it's coming off. We didn't get filled, fine. It still doesn't do anything. Comes back down to 24. We make $1 on this trade. Let's cover. Sold 30. Let's buy 30 shares back. So we make $1. So we just made 30 bucks. So if we go back to our original trade, we risked $110. We've taken 30 off the table. So now we have $80 of risk. Okay? Rallies again to 25. Hey, let's sell 30 shares again. We're scalping gamma. That's what we're doing. Wow, it keeps on rallying to 26. Okay, great. Let's sell 30 shares again. So we sell 30. We sell 30. If it keeps going higher, great problem to have, right? Because we're long one call, the equivalent of 100 shares. We sold 30. We sold 30. So we're still long, in essence, 40 shares of stock. As the market turns and comes back off, buy 60 back. Buy them all back. Okay, so what do we do now? We buy 60 back, sell 30, sell 30. So we make $2 on 30 of them, right? That's 60. And we made 30 on these. So we just made $90. Put that in our coffer. We made 30 on this trade. Now we just made 90. We're up 120. So now we have zero risk on our trade. We're actually up $10. We're up about 10%. We still have about, at this point, 25 days to go until expiration. We're up $10 on this trade. We can never lose that money. We're up money on the trade. Comes off. It rallies again. Oh, it came down. We really couldn't do anything here because remember, we're long the 21s. So forget about that. Rallies back up, 25s, sell 30. Keeps on rallying. You know what to do. Sell 30. Comes back off. Put a bid in there to buy 30 back. What you'll notice is we are never touching our options. We are never giving up the most powerful thing that we own, which is our optionality. We're up good money on this trade because we're up 10 bucks. But of course, as we're rallying here, we just locked in another $30 on the options because we're long the 24 strike. Now it rallies to 26. You make $2 on the options here. If it comes back off, we can buy the stock. And if it keeps running, stay long the call and get short 30 shares, maybe 40 shares. At expiration, you're long one call and you're short 100 shares of stock. You are flat. You are up money. This, folks, is how professionals manage an options trade. Why do we manage an options trade like this? Well, when you're long options, what's your risk? Your risk is premium coming out of your options. Theta, decaying. What's the opposite of theta? Glad you asked. It's gamma. Why do we scalp gamma? We scalp gamma to make back that theta. Okay? We need to know this. If you're risking money in the options market and you haven't learned this yet, you're learning the wrong thing. This is the stuff that we need you to learn. Okay? Hey, if you have any questions, support at Active Day Trader. You like this video? Give it a thumbs up, subscribe, share. It really helps. Thanks a lot, guys. My name's Jonathan Rose, owner of Active Day Trader.